and go. There we go. Don't want to miss out on that. So basically, mortgage insurance is extremely helpful for you and I, because let's think about it. How many closings would we be able to do if every single buyer needed 20% down? That could take years. And also a house that's worth $200,000 today, in say 3 to 5, however many years it would take to save up 20% down, that house is probably going to be worth, you know, upwards 250, possibly more. So it's even more that they actually have to save up. So mortgage insurance does have its benefits. Let's also discuss the difference between mortgage insurance and homeowners insurance. Every now and then there is a misconception about this, because, you know, people will look at the CD, buyers will look at the CD and they'll say, it looks like I was charged for insurance twice. Mortgage insurance and homeowners insurance are two completely different things. Homeowners insurance is what you carry on your house to protect you from theft, fire, disaster, wind, hail. So that is a completely different type of insurance, but both you will see typically as part of the monthly payment. So I just wanted to make that distinction quickly. And let me go back and share the screen. All right, it's up there, Danielle?
Yes, ma'am.
All right, perfect. All right, I wanted to talk a little bit about the different types of mortgage insurance. Now, not all loan types offer these different ways of payment, but I wanted to, again, put the terminology out there for you so you can recognize it. There's borrower paid mortgage insurance, and this is the most common. It's exactly what it sounds like. The borrower will pay for the mortgage insurance. There's also lender paid mortgage insurance. The benefit to this is that the borrower won't have those monthly payments. They are not paying it monthly. However, the trade-off here is usually that mortgage insurance is built into the interest rate. So the borrower is actually paying it, but paying it over a period of time. It's not as common to go this route, but just know that it is an option for some loan types. So I wanted to put that in there. Single premium. What that is you'll have a large upfront payment, but no monthly payments for the borrower. And then the split premium is basically a combination of a larger upfront payment and ongoing monthly payments. So let's start with an FHA loan, because again, every loan type is going to be completely different. An FHA loan will require mortgage insurance and an upfront fee. Upfront fee is 1.75% of the loan amount, not the purchase price, but the loan amount. The good news is this is not something that you have to pay out of pocket. It can be financed into the loan, and that's typically what happens. It's usually financed into the loan, and it's only paid once. Once it's paid, you are good to go. Now, it also has a monthly payment. Now, that monthly payment percentage does vary. And if we're talking about, and let's keep this to purchases for single families with a 30-year term, because that's the most common. If you're talking about those three factors, it's going to be anywhere from 0.8% to 0.85%. We're going to do the math on that in a second. But so that payment will be added into the monthly payment. Now, these numbers will be determined based on the down payment, the term of the loan, the property type, and other factors. So there's a misconception that if you have an FHA loan, there's absolutely no way that the mortgage insurance will fall off the loan without you refinancing into a different loan type. And for the most part, there is truth to that. However, if the borrower puts at least 10% down when they're purchasing with an FHA loan, there is the opportunity for the mortgage insurance to fall off after 11 years. So that is possible. So if you hear someone saying, no, my mortgage insurance will fall off my FHA loan, there is some truth to that. And that's probably what they're referring to. So let's do a quick breakdown of the math on this. And now I'm not expecting you to determine your own mortgage insurance on every loan type, but I just wanted to kind of give you a visual. That way you can see how these numbers are obtained. So let's say we have an FHA loan and the purchase price is $200,000. Well, the minimum down payment for an FHA loan is 3.5%. So that would be the borrower putting $7,000 down. That makes our new loan amount $193,000. Okay. Now, with the upfront premium that we spoke about, the 1.75% of the loan amount, that comes out to be about a little over $3,300. This can be added into the loan. So now what you're financing this here, it's $196,377.50. That's your new loan amount. Now, with 3.5% down, you're looking at a 0.85% of your monthly MI. This is determined annually. So if we do 0.85% of that new loan amount, we're looking at $1,670 annually. And when you divide that by 12 months, it is a payment of $139 a month. That number is added on to their monthly payment. So I hope that kind of gives you an idea of where these numbers are coming from. What do the percentages mean? So I just wanted to break that down for you. USDA, they actually call their mortgage insurance, it's a guarantee fee. So again, different terminology, but same concept. The upfront fee is lower at 1% of the purchase price of the loan amount. So that's a little bit, more affordable. It is, again, a one-time fee that can be rolled in, and the monthly is 0.35%. So that is a lower amount than the FHA loan. Now, one side of this is on the USDA loan, it cannot be removed. It will be on there for the life of the loan. Now let's look at VA. VA calls theirs a funding fee, and it's also very different. The only funding fee that they charge is the upfront fee. There is no monthly MI in a VA loan. So this percentage for the upfront fee will vary, and that's determined on, their eligibility, how many times they've used the loan, is it a purchase or a refi, and how much is the down payment? What's the down payment percentage? So again, VA has its own set of rules, and like all other loan types, you have to kind of evaluate the differences. Now, I waited till last to go over conventional because it does have the most moving parts. Now, the conventional loan does not have an upfront fee. So we're looking at strictly just your monthly payments, unless you have this loan type structured differently. But your loan payments are the monthly MI is going to be determined by many different factors. And this is your down payment. This is the term of the loan, the different conventional program that you may be using. If you're using some type of first-time home buyer program, credit score, property type, there are a lot of factors that play into this. And conventional MI is actually called private mortgage insurance. And that's why you've probably heard of PMI before. So the insurers of these loans are going to be private companies. So there is a little bit of a flexibility in the pricing. They're all pretty much priced very similarly, but it is something that we would shop around for. Now, the benefit of a conventional loan is the MI will drop off of it. It'll drop off typically automatically once you at least have 78% loan to value. But let's say that you've been in the house for a while, you did some improvements, the property value is going up quite a bit. You can always call your lender or servicer and say, look, I do believe that I have 20% plus equity in this house, and they'll tell you exactly what steps you would need to take. They may ask for an appraisal. They'll direct you in the right direction. That way you can see how you can get that mortgage insurance to drop off, which is a huge benefit when you're talking about your monthly payment. Now, I know I put a lot of numbers and jargon out there, but hopefully this last chart really kind of quick cheat sheet that puts it all into perspective. It goes over exactly the terminology used for each one of those loan types, what the upfront fee is, what the typical annual monthly fee is, can the MI be removed, and the best part is this monthly fee for every $100,000 financed. So you'll see here, for instance, with the USDA loan, if someone is financing $200,000, you're looking at about a $60 monthly fee that would be added on to their monthly payment. So that's 30 times $200,000. So you can use this to kind of estimate. Now, obviously, I do recommend have your buyers always talk to a lender first, make sure they get pre-approved ahead of time, and make sure that these loan options are being presented to them. I know a lot of buyers are very stuck and they're just looking for the lowest rate. Well, as you can see in this chart, lowest rate does not necessarily mean it'll be the lowest monthly payment or the lowest loan amount. So they have to look at their options and sometimes weigh it out, because just automatically assuming low rate is going to be the lowest monthly payment is incorrect. So that's kind of the gist of it. Danielle, I know I'm getting close to my time if I'm not over. Are there any questions that I need to go over?
We had one good one that came through. It says, single premium seems to make the most sense. Should we always encourage that option when possible?
Okay, so for a single premium, it has its benefits, but like everything we just talked about, there's always a give and take. So with that single premium, let's say they do end up refinancing or even selling the house. If they've paid all that mortgage insurance up front, most of the time they will not get refunded any of that. So you have to kind of know your game plan. Is this something that you're staying in for a while? Is this a mortgage that you're not planning on refinancing anytime soon? So again, that it does make sense, because of course, like most of us, we want to, let's get the payment out of the way so we can keep our monthly as low as possible. But sometimes it would actually make more sense for the buyer to pay a monthly instead of paying everything up front. So, and I also, go ahead, I'm sorry.
Go ahead.
I also want to say that this came across my desk not too long ago. I had a buyer that was hesitant to do a USDA loan because they were under the impression that once you went with a certain loan type, you had to stay with that loan type, even if you refinance for the life of the loan, or for the as long as you stayed in the house or were paying on a loan. And that is absolutely incorrect as well. In fact, the idea behind a lot of these loan types, like the FHA and the USDA, is if we do want to get rid of mortgage insurance, and that is the goal. Once you build enough equity in your house, you do want to get rid of mortgage insurance. So you will eventually want to refinance into a conventional loan where you're not paying that anymore. So letting these programs, letting you get into a house today, it may give you time to build that equity, to raise the credit score, to do the different things that you may need to do in order to qualify for a conventional loan and make that monthly payment lower due to no MI. So, all right, anything else, Danielle?
Are you going to be sending those, like the screenshot of the charts and everything over to
I will, yes, I will post it to 15withfallon.com under agent tools. We'll put this information in there. That way you can refer back to it. So it's 15 with Fallon. 15 is spelled out and Fallon is F-A-L-E-N. And also we will be looking at the attendees, the registered attendees on the call, and we will be choosing the prize giveaway. You'll be reached out to via the email that you registered. So please keep an eye on that. If you are the winner, you'll be seeing something very shortly after the call. So, Well, I appreciate you guys meeting with me again today, and I hope to see you next time. I hope y'all have a fantastic day, and bye-bye.
Bye. Thank you, Fallon.
Thanks.